It's a big mess. The Fed has lent $140 billion to the banks at this point in time, and there's still a big mess. Now, one quiz for tonight. Over here on the right, a guy named Barry Bonds. Remember him? He's got a home run record. Of course, over here on the left is Alan Greenspan, former secretary. The quote I just read you. What do these two guys have in common? Well, of course, the answer is they're both going to have their records marked with an asterisk. So, I didn't know if you knew this, but Einstein actually had another career. Before he did physics, he did a little finance, because physics is fun, and it's a great way to spend your declining years, but if you want to make some money, you have to do finance. That's where the bucks are. And he actually did some of the first subprime debt stuff. I don't know if you knew this. Now, the reason I bring this up is because, housing, we're a couple years into this mess. In the financial markets, Bernanke's doing what he can. He's given all the money in the Federal Reserve away to these banks to keep them liquid, which is important. So why are we going to have a recession? Well, the real issue about the second quarter growth rate was not what happened, but what didn't happen. We had the single largest amount of money just dumped on American taxpayers. An enormous amount of cash put out there in terms of those rebate checks. In the second quarter, we should have seen an enormous increase in consumer spending, and we didn't. It grew at basically a tepid pace. In fact, if you sit down and do some modeling, you remove those big rebate checks, you know what? We didn't have consumer growth in the second quarter. We had consumer decline. Actually, things would have gone down but for those checks. Now, the reason this is all happening, of course, is because the real imbalance in the economy is the consumer. And don't forget this. Over the past 10 years or so, you've had two enormous asset bubbles. First in the stock market, then in the housing markets. And all that incredible increase in wealth has caused consumers to feel like, hey, I don't have to save anymore. And savings rates, that's over here on the right, that went from 8% to 0%. Well, here's the bad news. All that fake wealth is now leaving us. There is no more stock market wealth. There is no more fake housing wealth. You're seeing a dramatic decline in net wealth in the U.S., and all that debt Americans have racked up, well, that's very real. That's remaining. And we're going to end up in a situation where consumers are so burdened by debt and really have no assets to draw on that they have to start saving again. Now, this is good for the long run of the U.S. economy, but it's bad for the short run. And watch out for that. It's the consumer that matters. It's the consumer that's going to be driving the next part of this cycle. And, of course, we know what that means for the rest of the economy, and we know what it means for housing. So the key here, of course, is consumers are really going to start pulling back in Q3, Q4. It's going to have a big impact on the overall market. It's going to hit those commercial markets. Watch out, particularly for retail. And, of course, you have all the other recession-related problems. Banks normally feel the greatest stress after a recession is over. Think about that. It's a lagging situation. Well, think of all the stress banks are facing right now, and we haven't even got into the overall recession. So watch out there. Any good news? Come on, inflation, give me a break. Over here on the left, who was around the late 80s? 15%? That's inflation. So with that in mind, I'm going to wrap up right now. Oops, I got blocked off. Again, the big messages tonight, we're not through this. We're not through this yet. We got the consumer cycle to come. It's going to be a bad downturn, but keep your eye on the end game. Mid-2010, this economy gets up. It's going to run again at a very rapid pace. The whole key is getting from here to there. So watch out, and good luck to y'all. Thank you.
Perfect. Just hang on to that. No, hang on to that. I think everybody else has their... How close was that to 10 minutes? I'm just curious. I'm just kidding. Thank you very much. That was very informative and very true. Our second speaker is Rick Sharga. He's the Vice President of Marketing with RealtyTrac. Rick joined RealtyTrac in 2004, where he's responsible for building and maintaining the RealtyTrac brand, corporate positioning and messaging, public and investor relations, and marketing communications activities. All you have to do is turn on any newscast, read a newspaper, and Rick Sharga is going to have had something to say about the foreclosures. Mr. Sharga.
Is the remote up there? Yep, there. Good evening. I wanted to thank Bruce for putting me on in front of the only entertaining economist in the country. And I got to tell you my only economist joke, and this was actually put out by another economist. It was Doug Duncan when he was the chief economist at the Mortgage Bankers Association. And he said the reason that God created economists was so that weathermen would look accurate. Having said that, I'm afraid that we pretty much agree with everything you just heard. And what I'm going to talk to you about really in rapid fire progression is one of the core drivers of all the problems that Chris was just talking about, which is the ridiculous number of foreclosures that we're seeing in the marketplace, and somewhat what's causing them. And it really, we're looking at a perfect storm here. So I have to thank the cartoonist whose copyrighted information I'm borrowing temporarily to put up on the screen for showing what some of this is all about. So we're going to talk a little bit about some of those foreclosures, assuming this clicker works. What it's looked like over the last couple of years, what the implications are for the housing market, the outlook for '09 and beyond. We're going to do all that as close to 10 minutes as we can. If you have turned on, as Bruce said, virtually any news media, whether broadcast, TV, radio, online, print, they're covering this story. In fact, we're hosting a panel at a conference next month on the mind of the media, because the industry is curious why the press is all of a sudden interested in this foreclosure thing. Like it's a secret they shouldn't be talking about. RealtyTrac's monthly foreclosure report was covered by itself in over 17,000 different press stories in the first half of the year. We're getting 3.5 million unique visitors to our website every month. Interest in foreclosures is unprecedented from a consumer basis. And as my boss, our CEO, Jim Sicasio, is fond of saying, we were one of the first people to really sort of democratize this information and make it available to people. So a lot of people that don't like the fact that this is out there blame it on us. I'd like to blame it on somebody else. And if you really think about what got us into this, imagine that you were looking for a loan a few years ago talking to your banker, and he said something like, as an alternative to the 30-year traditional mortgage, we have an interest-only mortgage, balloon mortgage, reverse mortgage, upside-down mortgage, inside-out mortgage, loop-to-loop mortgage, and the spinning double-axle mortgage with the triple Lutz. This is not normal banker behavior as we're taught in school. And what drove some of this behavior is an unprecedented integration of events that happened all at the same time. In the first place, we had Fed policy, which was alluded to a little earlier. Money suddenly became free. And if you remember, if you lived through the dot-com meltdown like I did at the end of the 90s and watched your 401k become a 200.5K, people were looking for another place to put their money. The Fed was trying to do something to stimulate the economy. 9/11 hit. That didn't help matters either. And so suddenly money became free. Suddenly, if you could fog a mirror, you could get a loan. In fact, if you knew somebody who could fog a mirror, you could get a loan. So the free money policy drove prices down, or the rates down, and drove artificially home prices up.